Most traders already have a strategy and they just don't realize it. In this video, I will show you how to turn one simple trading idea into a completely automated strategy and how just a few carefully chosen rules can change its performance. More importantly, we will build the entire strategy step by step so you can see exactly how intuition becomes something you can test, automate and improve. So at the end of this video, you will end up with new knowledge and one new strategy to test. Before we begin, please note that all information in this presentation is intended solely for educational purposes and nothing in this material should be considered investment or trading advice. Picture the situation. I'm watching the stock market and my reasoning goes something like this. Well, let's find the best stocks. I will find the best stocks, pick the ones that have dropped the most. I will wait for a bounce and sell the moment I decide the time is right to get out. And if I feel the overall market is weak, I simply will not trade. Let's look at a few examples, what's on my mind. With Apple, I see a sharp drop, so I tell myself, this could be an interesting opportunity. All I have to do is click the trade button and buy. With Coca-Cola, the price fell first, then rose, now it's weakening sharply again. Is it a trading opportunity? Well, hard to say, to be honest. This is what manual trading mostly looks like. A stock drops sharply, it looks cheap, I click and buy. At first glance, it seems logical, of course, but finding a genuinely suitable stock means manually clicking through dozens of charts one by one. And it's not 10 stocks, it's often 500 or more. Every single day. It's slow, it's tedious, and it's practically impossible to repeat the next day in exactly the same way. Part of manual trading is always based on, let's say, feelings. When we break the individual steps down, we find that each of them rests on an unanswered question. I tell myself, I will find the best stocks. But by what criterion do I decide which ones are the best? I will pick the ones that drop the most, but how exactly do I define the biggest drop? I will wait for the price to bounce. But how do I tell a real bounce from a continued decline? Or I will sell when I have a good feeling. But what exactly is that good feeling and how do I measure it? And finally, when the market is bad, I will not trade. And that's the biggest pain, because based on what do I decide the market is bad at the moment? These are all real questions with no concrete answers. This isn't a strategy. This is a guessing. The good news is that every of these feelings can be turned into a precise rule. Instead of vague phrasing, we define exactly what happens, when, and under what conditions. Guessing becomes a process that can be repeated, tested, and evaluated. Instead of the notion of picking so-called good companies, we will trade stocks from the S&P 500, that is 500 large, liquid, generally tradable companies. We will replace the phrase, the stock dropped a lot, with a precise definition. We enter when the price has to fall by more than 5% over 3 trading days. Instead of I will sell when the price bounces, for exit we set a clear rule. We close the position as soon as the price closes above the previous day's high. If no bounce comes, we close the trade after 10 days. This time-based exit ensures the position will not remain open indefinitely. If more than one stock meets the condition at the same time, we rank them by the size of the drop, pick the 10 with the largest decline, and put an equal share of capital into each. The difference compared with trading on feel is fundamental. We can apply these rules tomorrow exactly as we did today, and above all, we can test them in advance on historical data. Now what we want to do is we want to build a strategy rule by rule right inside AlgoCloud. We will create a new stock picking strategy for the S&P 500. As the data, we will use the stocks of the S&P 500 with history going back to 1995. We set commissions to 0.1%. For money management, we will keep it at 100% of capital. Both buy and sell or entry and exit orders will be executed on the bar close. Then we write out the individual rules. First, entry condition. The current closing price has to be more than 5% lower than the closing price 3 days ago. Second, exit condition. The current price rises above the previous day's high. Third, time-based exit. We simply close the position no later than after 10 days. Fourth, number of positions. A maximum of 10 long positions and no short positions. Fifth and the last, position score. The ratio of the current closing price to the closing price 3 days ago. The lower the value, the deeper the drop, and the higher the priority. So the entire strategy rests on just a handful of conditions and a few lines of code. The crucial difference is that AlgoCloud can now apply these rules to all 500 stocks every single day in a matter of seconds, something we could never manage by hand. After running the backtest, we will see if the strategy will have an edge or not. And the result is that the equity curve rises over the long run. However, it's choppy and the drawdowns are, let's be honest, painful. The maximum drawdown reaches 67%. Most investors would have a hard time stomaching a drop like that, of course. What we have to do is to add some filter. The first filter, the stock trend. We add a condition that we will only buy stocks trading above their 200-day moving average, meaning they are still in a long-term uptrend. That way, we avoid so-called falling knives. And let's make a fresh backtest. The curve is far smoother, the drawdown falls to roughly 35%, and the annual return reaches about 19%. A very solid result. Let's add the second filter, the regime of the whole market. The drawdown is still fairly deep, so we add one final rule at the level of the entire market. We will trade only when the ETF SPY is above its 200-day moving average. Once you set this rule, run the backtest. And after this backtest, the annual return does drop to about 14%, but the maximum drawdown shrinks to roughly 26%. And we never touched the entry logic even once. The improvement came purely from the filters. And finally, we compare the strategy against the benchmark in the equity chart, shown in percent. And the overall drawdown sits at around 20%. Once we turn the benchmark on, here's what we see. While the benchmark is in the market 100% of the time and generates about $274,000, our strategy trades only around 79% of the time, roughly a fifth less time in the market, and still earns nearly 3 times as much. If we normalize the results to the same drawdown, the difference is even more striking. The benchmark would earn about $41,000, whereas our strategy earns roughly $602,000, nearly 13 times more. The chart also makes it clear that during the market decline in the 2000, for example, the strategy was out of the market, sitting in cash, and therefore was not losing money. So, we started with nothing but unanswered questions: which stocks to pick, when to get in, when and how to get out, and how to recognize the right market conditions. We ended up with a set of rules that provide a concrete answer to every one of those questions, and that can be objectively tested across 30 years of history and 500 stocks. Because a good feeling will never show you your potential drawdown. A rule will. Your instinct, of course, already contains some rules, and they are just unnamed and untamed. All you have to do is turn them into a concrete form and let them be tested. And if you didn't know yet, you can build and test your first strategy in AlgoCloud completely for free. Just check www.algocloud.com and don't forget to follow us for more content from the world of algo trading.